The value of the Chinese currency, the yuan, has dropped to its lowest level per dollar in more than 2 years. However, it may get even worse, as key variables that have been supporting it thus far in 2022 appear to flip. What are these key variables? And in what ways will the housing shortage and local government revenue be affected? Calm down, viewers. Darkness Unraveled has got you covered. The Chinese yuan, also known as the renminbi, closed at $7.16 US last week. This has not occurred since May of 2020 and happened only twice in 2009. The yuan's decline this year has been worsened by a hawkish Federal Reserve and growing concerns over slowing global growth. This led to a sharp decline in the yuan's value and made it worth 12% less than the dollar. Though the yuan has fallen sharply, it has two major positives this year that have likely prevented it from falling even further. First, the People's Bank of China has kept monetary policy relatively tight despite a severe property downturn. They did this not by increasing interest rates, but rather decreasing them in order to support growth. This has been relatively unusual during serious Chinese slowdowns in the post-2008 era. Lower interest rates from the central bank have been rolled out gradually. Growth rate in the stock of aggregate finance to the real economy has slowed in recent months compared to the previous year. From a high of 10.9% in June, it dropped to 10.5% in September. Because of this and sluggish consumer demand, China's Consumer Price Index rose by only 2.5% in a year in August, which is incredibly low compared to historical norms. Second, China's trade surplus has been near record levels for much of 2022 due to the country's still vigorous exports and imports. The first and second quarter surpluses in China's goods trade were $145 and $176 billion respectively, coming close to the quarterly record of $187 billion set in late 2020. Both of these tailwinds are likely to turn against the yuan in the near future. Currently, it appears that exports will continue to slow down. An ugly recession is looming over Europe. Since early 2022, U.S. consumer confidence has fallen sharply, which had a significant negative effect on Chinese export growth. But that's not all. The Chinese central bank has also used other tools to minimize the damage. They increased the required risk reserve for financial institutions selling forward currency contracts, making bets against the yuan more costly. Yet the most powerful weapon against a depreciating yuan is China's $3 trillion war chest of foreign currency reserves and the foreign currency holdings of the country's banks. The value of the yuan would increase if people sold foreign currency and bought yuan. Economists say the drop of nearly $200 billion in China's foreign exchange reserves since the end of 2021 is, however, more likely the result of a strengthening dollar, reducing the dollar value of holdings in other currencies, than an indication that China has been deploying reserves on a large scale. Even though the unusual strength of the dollar is being felt around the world, the yuan has held up relatively well this year against other major currencies. In New York trading, the dollar gained 15% against the Philippines peso, 20% against the South Korean won, and 26% against the Japanese yen. The euro has lost 15% of its value against the dollar. So what makes the dollar so strong these days? The Federal Reserve's aggressive campaign of interest rate hikes to combat inflation in the United States is reflected in the strengthening of the dollar. That is attracting money from places where it can earn a higher return, which is causing local currencies to depreciate and prompting many other central banks to raise interest rates more quickly in an effort to stabilize their currencies and combat inflation. To counteract the effects of the real estate downturn and the government's zero-tolerance policy toward COVID-19 on the economy, the People's Bank of China, or PBOC, has been doing the opposite by cutting interest rates in China. China's central bank is one of the few where pressure is to ease financial conditions rather than tighten them. The loosening of China's monetary policy is still seen as necessary to forestall systemic financial and political risks in the country's property market. Officials may be waiting until after the twice-decade Communist Party Congress in October to make any significant policy changes, as President Xi Jinping is heavily favored to win a record-breaking third term as party leader. It's likely that China's exports will drop significantly by early next year, and that the country's central bank will begin to ease monetary policy. If China decided to use its foreign exchange reserves, it could significantly reduce the rate of depreciation. In practice, however, the government is unlikely to use them unless absolutely necessary. A sell-off in the yuan might not be seen as an unmitigated negative by Beijing if it does not lead to a panic. According to CEIC, China's external debt to GDP was 15.4% in 2021. While this is a large number, it is lower than it was in 2014 before the last Fed hiking cycle and is relatively low compared to most other large economies, with the exception of a few well-known sectors like property. Nonetheless, China's exporters could use the assistance, and with inflation so low, the cost of higher import prices is manageable. At the end of the day, Beijing's massive deployment of its reserves to fight the Fed in 2015 and 2016 only partially succeeded in halting the currency's fall. Perhaps more effective was tightening controls on capital flows, especially FDI, and watching the Chinese economy's life force, the property market, recovery in 2016. If China's government decided to go to war with the Federal Reserve, it would have the financial muscle to stand up to and even defeat the Fed. If it can slow depreciation through administrative measures and prevent a panicky sell-off, it may take a more hands-off approach, especially if its manufacturers find themselves in a nasty fight over a shrinking global export pie. Some economists have argued that the PBOC knows it has little sway over the Federal Reserve's actions and other fundamental factors contributing to the dollar's recent strength. The PBOC's credibility would be damaged if it tried to reverse market trends because it has little control over the fundamental forces supporting the dollar's rise. Economist Wei He from Gavical Dragonomics wrote that letting the current trend run its course while limiting volatility and waiting for the inevitable reversal of direction was the best course of action. When it comes to trying to stop the dollar's rise against their currency, China isn't the only Asian country making noises. Japan's Ministry of Finance bought yen and sold dollars in an intervention in the foreign exchange market on September 22. This was the first time such a decision had been made by the Japanese government since 1998. The major causes of the yen's depreciation, such as Japan's trade deficit and the interest rate differential between the US and Japan, are expected to remain unchanged, which means the yen will likely remain weak despite Japan's move. It's possible that other Asian central banks are also intervening in the currency markets, though they might not always make their action plan public. Taiwan, the Philippines, and Indonesia all have central banks with a history of intervening in the markets. It's fairly common at the moment, though most people use it to moderate the pace of a trend rather than actively counter it. Is the problem of depreciation ever going to be fixed? Tell us in the space provided below. As for me, I'm calling it a day. We hope the video was informative. We can't do this without our fans, so please subscribe to our channel to see more of our incredible videos. Thanks for watching.